Good morning, everybody. It's December 4th. Thanks for joining me this morning. Lots to talk about. We have lots of charts to review for you with regards to what the economy is doing, what the financial markets are doing. Here in Long Island, we've got a beautiful day, very sunny. We've had a string of these beautiful sunny days, just a little bit on the chilly side, but it is winter after all. But next couple of days, I'll be down in Sarasota, Florida. I won't be on the beach. I'll be attending a conference and giving a talk there about the economic outlook. Basically, the topic is, are we looking at the 1970s or the 1920s? Which analogy is more relevant? Well, you know where I've been coming from. I've been thinking that the odds that this will be a pretty good decade are fairly high. I haven't dismissed the possibility that it could be the 1970s all over again. As a matter of fact, when I first started talking about the roaring 2020s in 2020. At the beginning of the decade, I said, look, I think this is the way it's going to work out, but the alternative couldn't be a 1970 scenario. So we monitored it. And increasingly, in my opinion, the odds favor a happy outcome for the decade instead of something like the 1970s, where we had an entire decade that was called the Great Inflation. It's actually more than a decade. It really started in the mid-1960s when President Johnson decided to finance the war in Vietnam with deficits. So we had a guns and butter policy back then. In the second half of the 60s, that started to put upward pressure on inflation. Then Nixon came in the early 70s and took us off the gold standard. The dollar took a dive. Commodity prices soared on that. And then we had a couple of energy crises that immediately fed into wages because labor unions accounted for 35% of payroll employment back then. I estimate data doesn't go that far back. But right now it's only 6% of the labor force. But back then, the labor unions were very strong. The contracts included cost of living adjustments. So the price of gasoline went up, the price of food went up, and so did wages as a result of all that. And again, we had two energy crises. First with the war between the Arabs and the Israelis in 1973, and then we had, of course, the Iranian Revolution, and that caused the second spike up in oil prices. So it was definitely a terrible period for the economy. Saw unemployment awfully high. Productivity collapsed from something like 4% at the beginning of the decade down to zero by the end of the decade. And I pointed out that tight labor markets are actually a good thing for productivity, that tight labor markets, economic growth doesn't have to be a negative with regards to inflation. If in fact the economic growth is based on productivity, because there's labor shortages and companies respond to those labor shortages by boosting productivity, which is, I think, what we're seeing now. I think we're seeing the early stages of that. We discussed this last week, the notion that productivity growth might have bottomed at 0.5% on a 20-quarter trailing basis back in late 2015. And now we're up at 1.7%, and we still think that 3 to 4% is possible. I see that one of our competitors has started using the term roaring 2020s. I should have copyrighted it, but I welcome them to the fold here. The basic thing we all want is for prosperity, for good times, for people generally to be doing well. And that's what I see happening because productivity keeps inflation down. It boosts real wages. Productivity allows profits to stay high. And as I said, it allows wages to rise faster than prices, which is purchasing power, which is the standard of living. So I've got a fairly happy outlook. I'm not dismissing the possibility that things could go wrong. I'm not dismissing the possibility that there are problems out there. The geopolitical problems are right now pretty ugly, obviously. I don't know if war in the Middle East has become regional, but it still could become regional. We saw the rebels, not the rebels, the outlaws in Yemen, the ones that are supported by the Iranians, launching some missiles and drones towards ships in the Suez Canal, including U.S. destroyers. So we'll see how that plays out. I think it may be one of the reasons that the market's down this morning is the fear that this geopolitical situation in the Middle East is extremely unstable and it could widen. So things can certainly go wrong with that regard. But I'll be watching the price of oil. I think the price of oil is actually down today. But the price of oil should give us an indication whether this Middle East confrontation is going regional or not. Meanwhile, oil prices have come down, gasoline prices have come down. It looks like the November data are going to continue to benefit the way the October data did from lower energy prices for the consumer. So that's something we can look forward to. The FOMC meets soon, and I think they'll conclude that for the third meeting in a row, there's really nothing to be done. Fed Chair Powell last week on Friday said that the Fed is well into restrictive territory, not just getting into, but well into restrictive territory, implying that they're satisfied that they got where they wanted to be, and now they're just going to keep it here for a while. I know there's some people talking about significant cuts in interest rates next year. I see 2, maybe 4, maybe 50 to 100 basis points next year, but mostly because of what Fed Governor Waller said, is that if inflation in fact moderates, that might be enough to bring interest rates down a bit without it actually being a response to a recession. So basically, I think the Fed is getting more comfortable with the idea that they may actually succeed in getting immaculate disinflation, which is what I call it. The idea that inflation can come down without a recession. Well, let's go look at some of the let's go look at some of the charts here that are relevant to our discussion so far. Let's see. I have to figure out where. Oh, there's the sharing thing. Sharing is caring, as they say. And here we go. Yep, that's it. Well, I'm no technician, but I feel like a kid with a new toy here. I've got this new charting program that I've been pointing out to you for the past several weeks. We had a legacy program that did a great job of updating charts and all that for us, but we had some limitations with it, and so now we've got a new platform for doing charts. And basically, we've partnered with London Stock Exchange Group data stream. We're using their data and we're using their charting service, and it's pretty nifty. It does a lot of things. It was kind of frustrating at first trying to get to know the program, but the more we know it, the more we like it, the more power it has. And now I can actually annoy you with some drawing trend lines here, and you might be thinking, well, what's your Denny playing technician? Well, let me have my fun. Anyways, here playing technician here, you can see a couple of trend lines that were handy dandy, easy to draw. And now I think we're working on this downward resistance line. Let me get my handy dandy arrow here. And you can see we can have this resistance line connecting the all-time high with the July 31 high. And now we're obviously finding some resistance here. We looked like we were breaking out last week. Now we're back below. It's about 45.50. My year-end target is still 4,600, which is where we are. I'm not going to get greedy here. I'm not going to tell you we're going to go to 4,800 to 5,000. I'll save that for next year. Next year, I think we go to 5,400, which sounded kind of far-fetched and delusional a year ago, but that's what we said a year ago. And it looks a little less far-fetched than delusional, but our 4,600 target, which we established at the beginning of last year, I have to look it up. I think we might have established it actually at the end of last year. But at the beginning of this year, we certainly were talking about 4,600. And that was predicated on the notion that soft landing, no hard landing. inflation would moderate, that it's will turn out to be transitory after all. But we've had a heck of a move here. We are seeing probably some money coming out of the NASDAQ mega cap 8 kind of stocks. But I think it, so as it comes out, it weighs more on the market than money going into other parts of the market. But I think that's starting to happen. This, by the way, Joe Abbott pointed out to me that the value index for the S&P 500 went to an all-time high last week, which is pretty impressive, I think. Overall, the financials have come back nicely. The bank stocks have come roaring back because of the declining interest rates, boosting financial conditions. Even the spread between high-yield corporates and treasuries has narrowed dramatically. So a lot of the kind of indicators of stress in the financial markets are showing less stress, and therefore we've had this risk-on scenario. Again, I kind of like looking at this chart because we've had this tremendous rebound here, and I don't know if the market's buying into the roaring 2020s, but the market really started buying into the roaring 2020s, I think, at the end in November of last year, when the artificial intelligence hoopla all got going. Is it hype? I think one of you asked me the other day that you saw that I used Chat GPT, Bard, and so on. Actually, I tried them out. I tried to see if I could have them do my job for me, and the answer is no. That it would take me too long to proofread all the errors that they make. But there are a lot of other applications where it's turning out to be actually quite useful. And again, our AI is not the only technology out there that has the potential to increase productivity dramatically. Back to the story here, the plot line of the charts. You can see this is the equal weight versus the market cap weight. The market cap weight is back. Well, let's see, where are we looking at? The equal weight is the blue, obviously. Yeah. And so that's bounced back up. It's still further down below its record high of early 2022. Meanwhile, this is the equal. This is the equal weight. This is the market cap weight. Getting a little confused here. Anyways, it's probably just clearer to do it this way, and that's just to take the equal weighted and divide it by the market cap weighted, and you can see that maybe this is just a one-day phenomenon, but it could also be the start of a broadening of the market. As you know, the pessimists, the bears, the naysayers have been saying that it's really not a bull market that started in October of last year. That it's just a rally in a bear market. And their argument was that it's very narrow and only 8 stocks are going up and nothing else is going up. There's a certain truth to that, obviously. The numbers are the numbers. But instead of that being a bearish development, it could just be argued that instead, that if the economy continues to play out as we think, soft landing, transitory inflation, interest rates have peaked. Maybe they're coming down some, but not a lot. That could lead to a broadening of the market as people get less concerned about a recession, a credit crunch. Mid caps do better, and the equal weighted market does better than the market cap weighted. At least that's my story, and I'm sticking to it. Well, the rebound in the stock market has clearly been led by the bond market, by the fixed income markets. We've seen a significant drop off in the bond yield and in the 2-year. Only a few weeks ago, the discussion was, how much more is the Fed going to go? Are they going to do nothing, or are they going to be raising interest rates another time at the next meeting? And now the conversation is, well, how much will they lower interest rates next year? So that's interesting. We're in the camp arguing that it's not going to drop. They're not going to lower interest rates as much as the market seems to be anticipating. So that leaves us thinking that the bond yield stays in this 4 to 5% range. If you'll allow me to give you that kind of range for the market, but I don't see it going to three to four. And the 2-year could go somewhat lower, but the 2-year tends to be a forward indicator of where the Fed funds rate is going. And I think 4.5%, 4.75% is probably what we're going to be looking at for the Fed funds rate as a low for next year. I think the Fed's just going to be cautious. I mean, what's their motivation for lowering interest rates dramatically if the economy is resilient as we think it is and inflation's coming down? Why would they want to mess around with the Goldilocks scenario that they're shooting for by easing interest rates just because some forecasters are calling for it? Again, because I'm in the soft landing scenario, I'm not rooting for rates to plunge because I'm not rooting for a hard landing. Well, speaking of hard landings and soft landings, no landings, the Citigroup Economic Surprise Index has been coming down, and that's usually bullish for the bond market on a short-term basis. So slowing and growing is a good scenario. This is another positive development. It was back in September that the forward earnings bottomed, and it actually bottomed, I think it was in June, and then forward earnings has been increasing ever since. And Joe tells me that since September, it's been rising to new record highs. And so you can see that the forward EPS here is at $243. The analysts are looking for this year for 220, for next year 245. We're still more optimistic than that, at 225 and 250. But as I said before, we're probably going to shave a couple of bucks off the 225 for this year because of the UAW strike, though we haven't done it yet. Maybe we want to actually just stick with it and go through the earnings season and see how it plays out. Well, the other way to look at where the market thinks the Fed funds rate's going 12 months from now, the futures market saying 4.21%. So it's all good. It's all better than 5, 6, 7%. Jamie Dimon, only a couple of weeks ago, was saying that there's still 150 basis points to the upside in the Fed funds rate. But, for some reason, I don't know what he's been having for breakfast, but for some reason he's been persistently pessimistic about the economy. Said inflation is going to be higher. I think he's really rattled by the geopolitical crisis in the Middle East and in the Ukraine, and that's, I think, one of the reasons that he's particularly pessimistic. But we'll see. So figure 9 here. Jamie Dimon's been saying that consumers have been spending fumes, running on excess savings. Excess savings is supposed to run out by now. There's still, by some estimates, maybe $500 billion in excess savings. So that's a lot of pocket change still that could keep the economy growing. But we've been arguing that excess savings is not historically the source of growth for consumer spending. Historically, it's jobs and real wages. And as you can see here, both nominal and real wages, this is the red lines, are at all-time record highs. The blue lines show you another source of income. People forget that personal income isn't just about wages and salaries and benefits. It's also about things like interest, dividends, rent, and proprietor's income. All of those are all-time record highs, and that's the point of the blue line. That's a little flatter, but it's kind of kicked up a little bit. But it's certainly an important source of income, particularly to older Americans who have accumulated some bonds and stocks in their portfolios, and they're getting nice interest income and dividend income in their just to supplement their wages and salaries if they're working. If they're not working, they're going to be living off of that. And the increase in interest rates certainly is a big relief to a lot of people living on fixed income securities. Well, here's just another slice and dice of the real wage story, just to remind everybody that the consumer isn't spending isn't just totally dependent on excess savings, which they're about to run out of. This is average hourly earnings, wages divided by the consumption deflator. This is for all workers. This is for 80% of the workers. It's production and non-supervisory workers. We have data going back quite a bit. So you can see the real wage went up in the 60s, the real wage in the 70s and 80s. That didn't stagnate, it actually went down. So the great inflation was really a terrible period for real wages. And that continued to be the case until the mid 1990s. And in the mid 1990s, we started to see an upward trend here in real wages. That can only happen if productivity is making a comeback. And this slope is 1.4% per year on average, which is a pretty healthy increase in real incomes and kind of consistent with the trend in productivity. But you can see that there was stagnation here in the real wage during the pandemic, and that this year we're starting to crawl back along that upward trend line. So that plus payroll employment are fundamental sources of purchasing power, and I think they will continue to allow consumers to spend more. And I think the savings rate's going to stay low. A lot of baby boomers are retiring, and they're certainly not going to be doing saving. That was the whole point of saving while they were working. And so I think they're going to be living off their interest income, their dividend income, and maybe off of their assets. This is a payroll employment, all-time record high. You typically, during recessions, payroll employment goes down. Instead, it's going up to record highs. So there's no sign of a recession in that data. And it's, again, another source of purchasing power. This is the personal savings rate. As I just mentioned, it rebounded a little bit. Now it's kind of back down. It's certainly still well below where it was before the pandemic. And it may not go back there for a while, in my opinion, in which case, whatever people earn as personal income will largely be spent if the savings rate isn't going to go up. If the savings rate goes up, obviously they'll be doing more saving than they had been, and I don't anticipate that'll be the case. But that's the idea of the excess savings. As they run out of excess savings, and oh my goodness, we have no savings left. That's just not a plausible story. Net worth of the household sector, all-time record high. Baby boomers have half of that. I've gotten pushback from some of the younger folks out there saying, yeah, well, okay, baby boomer. Okay, boomer, I guess is the expression, or that's good, boomer. The idea being that this is all the boomers taken away from the young folks. But look, let's face it, the boomers aren't going to live forever. They got kids and they're going to leave them some dough. And many boomers are providing income even now to their young adult kids. So I say some of this from personal experience. Here's more on assets, net worth. You can see that the major assets, all the major assets that are held by the household sector are at or close to all-time record highs. So it's a pretty diversified portfolio of various kinds of assets. And again, a lot of the income inequality, wealth inequality in this country has a lot to do with age. Older people tend to have more wealth than younger people, obviously. And therefore, they also tend to have more interest and dividend income than younger people. So as Spock said, live long and prosper. That's the key to doing well. Save, accumulate wealth, and buy dividend yielding stocks and good bonds, and you too shall hopefully live long, and if you do, prosper. Okay, so just a couple of charts more here, just to show you what consumers are spending on, and what they're spending on is what you would expect older baby boomers, seniors to be spending on as they move towards retirement here. So we've got healthcare services spending all-time record high. This isn't in current dollars, but it's money. It's what's in your wallet. This is food. So they're spending more on food off premises. So you can see the food off premises is the red line over here, all-time record high. Nice upward slope. They're spending on selected travel services. This is airfares. This is hotels and motels, and they combine the two, all-time record high. And what is this? Fun-related services. Let's have some fun. Where's Taylor Swift in here? I think Taylor Swift is right there, the purple line. So she's had an impact there on both seeing her shows as well as going to football games. But you can see that consumers are spending a lot of money on services, and those services need a lot of people to employ, and that's why the payroll numbers have been persistently strong. Well, speaking of persistent, let's move on. This is just a negative number here. Anything housing related in consumption has been on the weak side. Well, what do we have here? We've got personal consumption expenditures deflator. It's been our story for the past 6 months that lo and behold, it may actually turn out that inflation was more transitory than persistent, that it had more to do with the pandemic than anything else, and that it's very symmetrical. And so far, that's working out awfully well. So life is good, right? Should be good, hopefully for most of you, all of you. I wish you well, but now that I've said all that, let's open it up for some discussion here. So Ian, enjoy Sarasota, thank you. Oh, a restaurant recommendation. Okay, sounds like a good place. Hojo. Ian, again, your thoughts on huge automation and productivity boom next 10 years with AI chips, software, and quantum computers and new chips. I love it all. I mean, there's so many technologies out there that can all by themselves and in combination with one another lead to a greater productivity. Somebody just came back to visit us here. Go ahead, Max. Take a snooze. For tomorrow's morning briefing, or this afternoon for the advanced copy, we're going to show you a chart showing construction of manufacturing facilities, and it's off the charts. And those manufacturing facility structures are going to be full of automation, robotics, artificial intelligence, and so on. I missed the story on 60 Minutes last night. I'm going to see if I can see it again, but apparently they had a story on quantum computing, and that could be sort of the next stage of the high-tech revolution. The first stage of the high-tech revolution was the 90s. Then the second stage of the high-tech revolution is now, and maybe quantum computing 5 to 10 years from now becomes the next stage of it. Jake, how should we think about the impact, if any, of next year's elections on the market? I'm thinking perhaps about political pressures to cut rates and stimulate the labor market, even if might not be wise. Well, I don't know. I don't know that the White House is going to be putting a lot of pressure on the Fed to lower interest rates, because at least the Fed seems to have stopped raising interest rates. That's good for starters, but from a politician's perspective, happens to be an incumbent. And there could be a couple of rate cuts next year, which should calm any politician who wants to beat up on the Fed. But the Fed, I don't think, would respond to political pressures next year. Not to say that they might have been influenced somewhat in the past. But with regards to the overall political story, I guess my fallback always has been, look how well this country has done, despite the politicians, despite the clowns running this country, and they're getting to be more and more clownish all the time. Witness this fellow Santos that got booted out. But I think that there's so many of us working stiffs that are going to do the best we can every day that factor in how Washington is trying to get in our way, and yet somehow or other we just continue to increase the prosperity, productivity, efficiency, wealth, income of this country, and let's just keep doing it. The problem for us working stiffs is we really don't have a lot of time to play politics. So those who have plenty of time to play politics are always trying to game the system and take advantage of the system at the expense of the working stiffs like ourselves. And yet, despite all that, real GDP is an all-time record high. Net worth of households, all-time record high. The economy is doing well. You wouldn't know that listening to some of our competitors, even on Wall Street. Let's see, almost done here. Conrad, if you still see Treasury yields at 4.5% to 5%, wouldn't that mean a rebound in the yield just as 10 years have rebounded today from its technical support at 4.24 original? Yeah, I think that makes sense. You know, I thought that there'd be buyers at 5%. I didn't think that didn't expect that they'd bring him down at 1 month to 4.5% and now to 4.25%, and that is the high that we had last year was 4.25%. I actually last year thought 4.25% was the high, and then I realized that was not the case, and suddenly I had to start thinking about, well, how much higher than 4.5% was it going to go, and 5 seemed to make sense to me, and here we are back at 4.25%. So we're back where I thought rates the bond yield should peak. If you look at the bond yield where it was before the great financial crisis, it was basically between 4% and 5%. That was so we're kind of returning to the old normal, if you will, and I think that's what I'm thinking. Let's see, we got a bunch more, but I'll only take one more. Ed, thank you for the information. What do you think of the geopolitical tensions in China, Taiwan, Ukraine, Russia, and Israel, and how we should position international exposure? I continue to recommend overweighting the U.S. Relative to the rest of the world. I think China's got this property bubble that's burst. So I think they're in a recession, depression, certainly in the property market. And as you know, their stock market's down about 50%. Maybe that makes it a screaming buy. I don't think so. It's cheap for a reason. The negative wealth effect from property and stocks, I think, is going to weigh on China. With regards to, as a result of that, I think the risks that China will invade Taiwan anytime soon are reduced because they've got a lot of problems at home now. Of course, the flip side of that is sometimes autocrats stir things up on a global basis, start wars to distract people from the misery that they have at home. So that's something to consider. But I don't think China is going to do that at this time. But so I would say that risk is somewhat diminished. The Iran-backed faction in Yemen seems to be playing the role of launching drones and cruise missiles at ships that might be Israeli or might be just represent countries that haven't come out forthrightly against the Israelis as far as they're concerned. And the U.S. Spent a few hours, apparently, according to Pentagon sources, retaliating and launching some cruise missiles. So that situation is still unstable, but all we can do is, as I said in the quick takes, is let's monitor the price of oil and let the price of oil tell us whether this situation is becoming regional. Ukraine and Russia looks like a miserable, long, drawn-out war. Depending on what I'm reading, it looks like it's going to be a stalemate forever, or the Russians are going to get into a position where the Ukrainians are going to be forced to negotiate some terrible peace agreement. But I think the bottom line of all this is so far these problems have not had an impact on the global economy. It did early last year in terms of food prices and oil prices, but it looks like the world's learned how to handle that geopolitical disturbance in Ukraine and Russia. Grain must be coming out of Ukraine one way or the other. So all in all, there's always something to worry about. And there's a lot of people who are doing a really good job of scaring the living daylights out of us. And I'm not dismissing what they're saying. I'm listening to what they're saying. But hopefully you find that we provide some balance that keeps you from getting too pessimistic along with their view. So thanks for joining us. Have a good week, and I'll see you next week. All the best.